Have you ever wanted to start investing in Australia but felt completely lost because everyone's throwing around words like ETF, franking credits, and dividend yields? If so, don't worry, you're not dumb. The finance world just loves to make everything sound more complicated than it really is. So in this video, I'll break down all the key investing terms and jargon you need to know as a beginner Aussie investor, in plain English. By the end, you'll understand what people actually mean when they talk about buying blue chips, reinvesting dividends, or index tracking. And make sure you stick around till the end because I'll share a few sneaky Australian-only investing terms most people outside the country have never heard of. Let's get straight into it. Let's start with the foundation, the terms you'll hear every day. Share. A share is a single unit of ownership in a public company. A public company is a business that is listed on the stock market which you can buy shares of. When you buy shares in a company listed on the stock market, like CBA or Woolworths, you legally own a portion of that company, even if it's tiny. In Australia, the word share is far more common than stock. A stock refers to the overall ownership in companies or the asset class in general. Though often used interchangeably, Australians typically say shares when referring to specific companies and stocks when speaking more generally. For example, I own 50 shares of CBA. Tech stocks went up today. But in everyday Aussie conversation, they basically mean the same thing. ASX stands for Australian Securities Exchange. The ASX is Australia's main stock market, the place where shares of Australian companies are bought and sold. When a company lists on the ASX, it means shares can now be purchased by everyday investors. Think of the ASX as the marketplace where buyers and sellers meet, just like a giant online auction for investments. Portfolio. Your portfolio is the complete collection of everything you've invested in. In Australia, this often includes shares, ETFs, superannuation, REITs, cash holdings, managed funds, and even cryptocurrency if you include it as part of your strategy. Your portfolio shows your complete investment picture, not just a single stock or ETF. Broker/brokerage account. A broker is a platform that lets you buy and sell investments on the ASX or international markets. Some popular examples in Australia include CommSec, Self-Wealth, and Moomoo. Most brokers are now online. It's cheaper and easier for customers to buy stocks through an app or platform. Physical brokers still exist in Australia, but they're becoming more rare. Your brokerage account is like a digital wallet where your shares sit. A ticker symbol is a short code, usually 3 letters, that identifies the company or ETF on the ASX or any other international stock market. For example, on the ASX, CBA equals Commonwealth Bank, BHP equals BHP Group, WOW equals Woolworths, and VAS equals Vanguard Australian Shares ETF. These codes are used to trade quickly and avoid confusion between similar company names. Market cap. This is short for market capitalization. Market cap is the total value of a company based on its share price. The formula of a market cap equals share price multiplied by the number of shares on issue. For example, if a share price of a company is $100 and there are 1 billion shares, the market cap equals 100 billion. Blue chip stocks. Blue chip stocks are large, well-established companies with strong reputations, stable earnings, and long histories. In Australia, these usually include banks, so CBA, NAB, ANZ, and Westpac, retail giants like Woolworths and Coles, and miners like BHP and Rio Tinto. They are generally considered lower risk, more stable, and often pay steady dividends. Mid-cap and small-cap stocks. These refer to companies with smaller market caps than the big blue chips. Mid-cap equals medium-sized companies, and small-cap equals smaller, younger, often higher growth companies. In Australian stock market slang, they are often referred to as speckies or short for speculative shares. They have the potential to grow faster than blue chips, but are usually more volatile and risky. Many ASX growth stories start in the small-cap space. Examples of mid-cap companies include JB Hi-Fi and Xero. And examples of small caps include emerging tech, bio, and mining explorers. IPO. IPO stands for Initial Public Offering. An IPO is when a private company sells shares to the public for the first time and becomes listed on the ASX. It's often marketed as a chance to get in early, but IPOs can be overhyped, prices can fall after listing, and companies have limited track records as public businesses. Buy, sell, order. These are instructions you give your broker when you try to buy or sell a stock. Buy order equals you want to purchase shares. Sell order equals you want to sell shares. Bid and ask price. This is the pricing negotiation happening on the ASX. Bid price are what buyers are willing to pay, and ask price are what sellers are willing to accept. Now let's talk about what actually happens when you invest. Share price. A share price is the current cost of buying one share of a company on the stock market. It's basically the dollar amount that investors are willing to pay right now for a single unit of ownership in that company. Share prices constantly move up and down based on supply and demand, which is how many people want to buy versus sell, company performance, so profits, growth and announcements, market conditions, including interest rates, economic news, global events, and investor expectation about the company's future. For example, if a company's share price is $50, that means it costs $50 to buy one share today. If tomorrow more people want to buy the stock than sell it, the price might rise to $51 or more. Dividends. Dividends are payments a company makes to its shareholders from the profits it earns. In Australia, many large companies, especially banks and mining companies, pay dividends regularly, often twice a year. Dividends can be cash payments straight to your bank or brokerage account, or reinvested automatically through a dividend reinvestment plan. More on that later. Dividend yield. Dividend yield tells you how much income a share pays you relative to its price. The formula of a dividend yield equals annual dividend divided by the share price. For example, if a company pays $2 per share in dividends annually, and its share price is $40, the dividend yield is 5%. So higher yield equals more income. But here's the thing, a high yield isn't always good. Sometimes it means the share price has crashed. This is called a dividend trap. Distribution. A distribution is the income paid out to investors from certain types of investments, most commonly ETFs, managed funds, index funds, and REITs. It's similar to a dividend, but the word distribution is used for funds rather than individual companies. Distributions are typically paid quarterly, semi-annually, or annually, depending on the fund. For example, if you own VAS, which is an ETF of the ASX 300, you don't get dividends directly from every company. Instead, VAS collects dividends from those companies and pays you a distribution. Franking credits. Franking credits are a uniquely Australian tax benefit attached to dividends. Here's how it works. Australian companies pay corporate tax, usually 30%, before paying dividends. To avoid taxing shareholders twice, the ATO gives investors a tax credit for the tax already paid. It's one of the biggest reasons income-focused investing is so popular in Australia. Capital gains. Capital gains are the profits you make when you sell an investment for more than you paid. For example, you buy a share for $20. You sell it later for $35. Therefore, your capital gain is $15. Please note you only make a capital gain when you sell. Until then, it's simply called a paper gain. Capital gains tax, or CGT for short. Capital gains tax is a tax you pay on your profits when you sell an investment like shares, property, or ETFs. In Australia, capital gains tax has a big rule. If you hold the investment for more than 12 months, you get a 50% capital gains tax discount. That means if you made a $10,000 capital gain, you only pay tax on $5,000. This is why long-term investing is considered tax efficient in Australia. You'll also hear about types of investments people use. ETF stands for Exchange Traded Fund. An ETF is a basket of many shares packaged into one investment, and it trades on the stock market just like a regular share. Instead of buying individual companies, you can buy one ETF and instantly own tiny pieces of hundreds or thousands of companies. Most ETFs track an index, like the ASX 200, which is Australia's 200 largest companies, or the S&P 500, which is the top 500 US companies. They're popular because they're diversified, cheap, easy to buy, and transparent. Some popular examples in Australia include VAS, which is the Vanguard Australian Shares ETF that tracks the ASX 300. VGS, which is the Vanguard International Shares ETF, which tracks the world's developed markets excluding Australia, and IVV, which is the iShares S&P 500 ETF that tracks the US market. They are popular with beginners because it's a set and forget style investment. LIC, which stands for Listed Investment Company. A LIC is a publicly listed company that invests in other companies. When you buy a LIC, you're buying shares in the LIC itself, which then invests your money on your behalf. LICs have a fixed pool of money, unlike ETFs, which can issue unlimited units. They are often actively managed, meaning humans decide what to buy and sell. Examples of popular LICs in Australia include AFIC and Argo. Managed fund. A managed fund is an unlisted investment, meaning you don't buy it on the stock market. You give money to a fund manager who pools it with other investors and invests it based on a specific strategy. You buy and sell units directly through the fund provider, not the ASX. Index fund. An index fund is a type of managed fund or ETF that simply tracks the market index. For most people in Australia, buying an index fund through an ETF is the easiest, fastest, and most accessible way to invest in index funds. So some examples of indexes include ASX 300, which is the top 300 companies in Australia, S&P 500, which is the top 500 US companies. Index funds are extremely popular because they provide broad diversification, low fees, and predictable performance. REIT, Real Estate Investment Trust. A REIT lets you invest in property through the stock market instead of buying physical real estate yourself. REITs own commercial properties such as office buildings, shopping centers, industrial warehouses, and healthcare facilities. They earn income through rent, which is paid out to investors as dividends. It's good for people who want exposure to property without needing a deposit or taking out a mortgage. Popular REITs in Australia include Scentre Group and Goodman Group. Bond. A bond is basically you lending money to a company or a government. In return, they promise to 1. Pay you regular fixed interest, and 2. Give your original money back on a specific date, which is known as the maturity date. Bonds are considered lower risk than shares because the borrower is legally required to pay you back. Governments issue bonds to fund projects, and companies issue bonds to raise capital. Commodities. You probably hear this word a lot on the news. Commodities are physical goods that are used in the global economy. Examples include gold, silver, oil, natural gas, iron ore, wheat, and lithium. You can invest in commodities through futures, ETFs, or mining companies. They tend to be more volatile but act as a hedge in uncertain markets. Once you start learning strategies, these terms will pop up. Diversification. Diversification means spreading your money across different assets, industries, and sometimes countries so you're not relying on a single investment to perform well. For example, instead of putting all your money into one company, you might buy a mix of Australian shares, global shares, ETFs, bonds, and property trusts. The idea is simple. If one investment performs poorly, the others help balance it out. It reduces risk without reducing long-term returns. Asset allocation. Asset allocation is the overall mix of assets in your portfolio, usually divided into growth assets like shares and property, defensive assets like bond and cash. So for example, the average Australian investor might be 70% shares, 20% bonds, and 10% cash. Risk tolerance. Risk tolerance measures how much market volatility you can emotionally and financially handle. If your portfolio drops 20% during a market crash, can you stay calm and keep investing, or will you panic sell? Younger investors often have higher risk tolerance because they have more time to recover. Older investors nearing retirement usually prefer stability. Volatility. Volatility refers to how much and how quickly the price of an investment moves up and down. High volatility equals big swings. So for example, small cap stocks. Low volatility equals smaller, steadier movements. So maybe large caps and bonds. Volatility doesn't always mean something is bad. It just means prices fluctuate more, often associated with higher potential returns. Bear market. A bear market is when the market falls 20% or more from its recent highs. It typically happens during economic downturns, recession, or major global shocks. In bear markets, investor confidence drops, people panic sell, and the media becomes extremely negative. Despite the fear, bear markets are normal and temporary, usually lasting 6 to 18 months historically. Bull market. A bull market is the opposite, when prices are rising steadily and investor confidence is high. For example, Australia enjoyed a long bull market during the mining boom. Correction. A correction is a temporary market drop of around 10%, usually lasting weeks or months. It's not as severe as a bear market and often happens after markets run up too quickly. Corrections are considered healthy. They reset valuations and create buying opportunities. Recession. A recession is when a country experiences economic decline, usually measured as 2 consecutive quarters of negative GDP growth. During recessions, unemployment rises, consumer spending drops, and corporate profits fall. Recessions often coincide with bear markets, but not always. Dollar cost averaging, or DCA. Dollar cost averaging is a strategy where you invest the same amount at regular intervals, regardless of whether the market is up or down. This strategy removes emotion, smooths out market volatility, and often leads to better long-term results because you buy more units when prices are cheap. It's one of the most beginner-friendly ways to invest. Now for some uniquely Australian investing terms you won't find elsewhere. Let's start with CHESS-sponsored account. A CHESS-sponsored brokerage account means your shares are legally held in your own name through the ASX electronic settlement system called CHESS, which stands for Clearing House Electronic Subregister System. When you're CHESS-sponsored, your shares are directly tied to your personal holder identification number, not held by a third party. You have more control and transparency, you can see every holding under your HIN, and you're protected even if your broker collapses because your shares are on the ASX books, not the brokers. This is why many Australian investors prefer CHESS-sponsored brokers like CommSec, Selfwealth, and Moomoo. Custodial account. This is the alternative to CHESS-sponsored accounts. A custodial brokerage account means the broker or a third-party custodian holds the share on your behalf instead of you holding them directly. This is the alternative option to CHESS-sponsored brokers. You don't get your own holder identification number. Instead, your holdings are under the broker's umbrella holder identification number. You still benefit financially, but legally, the custodian owns the shares. Holder identification number or HIN. Your HIN is your unique identifier within the ASX CHESS system. It's like your investor license plate number. This number starts with the letter X and links all your CHESS-sponsored holdings. Think of your HIN as proof of ownership for your Australian shares. Franked versus unfranked dividends. Franked dividends come with a tax credit because the company has already paid 30% corporate tax. This prevents you from paying tax twice on the same income. So if your personal tax rate is higher than 30%, you pay the difference. If it's lower than 30%, you get a tax refund. Unfranked dividends don't include this tax credit because the company hasn't paid tax yet, which is common with REITs and some LICs. Franking credits can be a major advantage for income-focused Aussie investors. Dividend Reinvestment Plan, or DRP for short. A DRP lets you automatically reinvest your dividends into additional shares of the same company instead of receiving cash. So this is why investors love DRPs. There are often no brokerage fees. It helps your position passively. It leverages compound growth because more shares equals more dividends equals more shares. So it can be a good strategy for long-term wealth building. ASX 200 and All Odds. These are two of the most referenced Aussie share market indexes. ASX 200 tracks the top 200 largest companies listed on the ASX. It is market weighted, so bigger companies like CBA and BHP has more influence. It's used as a benchmark for many ETFs such as the A200 ETF. All Ordinaries, or All Odds for short, tracks the top 500 plus companies on the ASX. It gives a broader picture of the entire Aussie stock market. When you hear on the news the market was up or down today, they're usually talking about the ASX 200. So there you go, a full rundown of the key investing terms every Aussie should know. But remember, this is not just a list of definitions, this is financial language. And once you start to understand the language of money, the whole world of investing suddenly feels a lot less scary and a lot more empowering. I wish you all the best on your journey. And quick disclaimer, this video is for educational purposes only. All the examples I use in this video are for educational purposes only and are not buy recommendations. Please remember, investing involves risk, so please do your own research before making any decisions. And if you'd like financial advice, please go speak to a professional. By the way, if you're enjoying this video and made it this far, comment the words Aussie investing jargon down below so I know who you are. And if you're new around here, what are you waiting for, mate? Hit the subscribe button and join this awesome community of like-minded people who are all trying to level up their money and their life. Also, make sure you follow me on Instagram where I post heaps of lighthearted, easy to digest finance content. And if you want to go a little bit deeper, you can sign up to my free email newsletter, Aussie Money Club, where once a week I'll send you some money tips, major news in the market, or any cool updates from me. And if you want to learn more about investing in Australia, check out this video on screen where I'll show you a beginner's guide on how to start investing in Australia as a beginner. And as always, thank you for watching, I appreciate you, and I'll see you in the next video.